The International Accounting Standard Board issued the Conceptual Framework for Financial Reporting in September 2010. This is known as the IFRS Conceptual Framework, which underlie the preparation and presentation of financial statements for external users. The conceptual framework is designed to assist standard setters in developing and reviewing standards, assist preparers of the financial statements in applying standards and dealing with issues not specifically covered by the standards. It also assists auditors in forming an opinion on financial statements and assists the primary and other users in interpreting financial statement information. The diagram here depicts the IFRS conceptual framework. The objective of general purpose financial reporting is at the center in the diagram. All other aspects of the conceptual framework are based on the objective. The objective is surrounded by qualitative characteristics of useful financial information. These include the fundamental characteristics of relevance and faithful representation. Remember that materiality is an aspect of relevance, and the enhancing qualitative characteristics, which include comparability, verifiability, timeliness, and understandability. We will discuss each of these fundamental and enhancing characteristics in details later. The diagram then shows the elements of financial performance and financial position. Particularly, financial performance include income, expense, capital maintenance adjustments, and past cash flows. The financial position elements include assets, liabilities, and equity. Underlying the conceptual framework are the constraints, which include cost-benefit considerations and the underlying assumptions such as accrual basis and going concern that help guide the preparation of standards as well as preparing financial reports. The objective of financial reporting is at the core of the conceptual framework. It is to provide financial information that is useful to current and potential providers of resources in making decisions. The providers of resources to the reporting entity are considered as the primary users of financial reports and information. These providers include investors, lenders, and other creditors. The purpose of providing financial information to these users is to be useful in their decision making to provide resources to the reporting entity. The information needs of these decision makers may vary and may be unique. However, they are generally grouped into financial performance and financial position. Information is needed on a company's resources and its obligations, as well as information on financial performance including cash flows, etc. The conceptual framework indicates that such information should be helpful in assessing the future net cash flows of the reporting entity. However, the conceptual framework also suggests that users should consider other sources of information that can be useful in decision making. What constitutes useful information for the providers of resources? That is, what information is useful in decision making? The conceptual framework identifies two fundamental qualitative characteristics that is considered to make financial information useful. These fundamental qualitative characteristics are relevance and faithful representation. Information is considered relevant if it would potentially affect or make a difference in users' decision. Information may be relevant because of its predictive value or confirmatory value, or both. Predictive value of information indicates its usefulness in making forecasts. Confirmatory value indicates its usefulness to evaluate past decisions or forecasts. In other words, relevant information helps the primary and other users of financial information in evaluating past, present, and future events, as well as to confirm or correct their past evaluations in a decision-making context. A close aspect of relevance is materiality, where information is material if its omission or misstatement can affect the user's decision. Information is material because of its nature or magnitude or both. To understand materiality, let's assume that a company has total assets of $100 million. One of its customers, that owes the company $1,000 defaults on the payment. Such default is immaterial to the financial statement because of the size of the default. On the other hand, another customer owes the company $5 million. If such customer defaults on the loan, it will be material for financial reporting. Similarly, if a company is planning to curtail its operations in a particular geographic location that has been contributing significantly towards the operating performance, it must be disclosed as it is material and helps the user in understanding the future operation of the company. Also note that materiality is not only related with relevance, but it also is related with reliability and completeness of the financial information. Faithful representation is the second fundamental characteristic. It states that the financial reports produced are accurately reflecting the economic reality of the business. Therefore, it covers both financial position and financial performance, including the cash flows of the reporting entity. To be considered as faithful representation, the financial reports should have complete, neutral, and free from error information. Complete means that all the necessary information required to understand the economic reality of the reporting entity are fully provided. No information is omitted that has the potential to affect decision making. For example, if a company reports that it has a loan of $10 million and does not provide any additional information such as the maturity date of the loan, this information is incomplete. Financial information is neutral when the financial statement represents the actual reality of an organization without amplifying it or without reducing it to any extent. In other words, financial statements are neutral when they do not provide an overly optimistic view of the business to encourage lenders, investors, and other creditors to provide resources to the reporting entity. Also, neutral financial statements do not make the business look worse in order to reduce income tax liability or any other claim on the business. Faithful representation also requires information to be free from error. There should be no errors of commission or omission in the description of economic reality. An appropriate process should be used to arrive at the reported information, and this process should be adhered to without any errors. Errors in financial statements that are repeated may result in biased financial statements in a certain direction, and in certain situations may lead to financial reporting frauds. In addition to the two fundamental characteristics, the framework also identifies 4 enhancing qualitative characteristics of financial information to be useful. The first one is comparability. Comparability requires that companies record and report financial information in a similar manner. Financial statements of one accounting period of the company must be comparable to another accounting period. This will allow the users of financial statements to derive meaningful conclusions about the trends in the reporting entity's financial performance and financial position over time. Comparability and hence consistency can be ensured through the application of similar accounting policies over a period of time by the reporting entity. However, to improve the reliability and relevance of financial statement, a reporting entity may be required to change its accounting policies. At times, accounting standards may require the reporting entity change its accounting policy. In such situation, the nature as well as the circumstances leading to changes in the accounting policies must be adequately disclosed in the financial statements. Comparability also implies that reporting entities that are in the same line of business must have their financial statements comparable. This allows the users of financial statement to compare the financial position and performance of one reporting entity against another reporting entity in the same line of business. Therefore, it is essential for entities in the same line of business to adopt accounting policies that reflect the best practices in the industry at the time. Verifiability means that different knowledgeable and independent observers would agree that the information presented in the financial statements faithfully represents the economic reality of the reporting entity. Information presented in the financial statement of the reporting entity is considered verifiable if two independent accountants such as auditors can reasonably conclude that it is fairly reflecting underlying transactions and circumstances of the reporting entity. Verification of the information in financial statements can be done either directly or indirectly. For example, the cash in hand reported in the balance sheet can be verified through cash count at the year end. Similarly, depreciation can be indirectly verified through recalculation based on the rate of depreciation and assets net book value reported in the balance sheet. Inventory, on the other hand, can be directly verified through stock count at the year end, or it can be indirectly verified through the recalculation of the value of inventory using the FIFO or the average cost method. Verifiability is important for the users of financial statements so that they can trust the information provided in the financial statements. It assures the users of financial statements that the information provided in the financial statements is true and fair representations of the underlying transactions and circumstances of the reporting entity. Companies have to sometimes report forward-looking information in their financial statements which is currently not verifiable, however it is relevant for decision making by the users. One example is the pending legal dispute. In such cases, the company must disclose and provide all relevant information to help the users of financial statements assess the reliability of the estimate. Remember, verifiability is not a fundamental but a highly desirable enhancing qualitative characteristic of financial reporting. The third enhancing qualitative characteristic is timeliness, which means that the information provided is available before it loses its relevance. Information is more relevant to the users if it is timely presented. Delay in the presentation of information reduces its relevance for decision making. For example, companies must provide their financial statement on timely basis to the users of financial information so that they can make informed decisions. Companies report on their financial performance on regular basis such as quarterly, semi-annual or annual basis depending on their size and complexity of business. Regulatory requirements also impose restrictions on companies on the reporting frequency they can use to report on their financial performance. However, timely presentation of financial information has a conflict with the objective of presenting reliable information. Producing reliable and accurate information is time-consuming, and that will delay providing accounting information, which will make it less relevant. Therefore, it is important to have a trade-off between timeliness and reliability of financial information. Understandability is the fourth and final enhancing qualitative characteristic. Financial information must be presented in the financial statements in such a manner that it is easily understandable to an informed user. An informed user is someone who has a reasonable level of knowledge of the business, economic activities, and accounting in general. However, some complex financial information may not be easily presentable in an understandable form. In such cases, such information should not be excluded simply because it is too difficult to understand. It may be necessary for the user to seek assistance to understand information that is complex. The case of Enron is a good example to understand this point. Enron used very complicated structure of special purpose entities. These were presented in the financial statement in such a form that it concealed the financial risk exposure of Enron. As a result, the capital market participants consistently overvalued Enron over time. All this continued till year 2001 when Enron filed for bankruptcy. Assets, as we know, are resources controlled by the enterprise. Liabilities represent claims on the resources, that is the assets of the enterprise, and equity represents the residual interest, that is assets minus liabilities of the enterprise. Income measures the increases in economic benefits in the form of inflows or increases in value of assets or decreases in the value of liabilities that result in increasing equity. As we know, equity represents the residual, that is assets minus liabilities. However, income does not include any increase resulting from contribution by the owners, for example, issuing new shares. Expenses, on the other hand, represent decreases in economic benefits in the form of outflows or depletion of assets or increases in liabilities that result in decreasing equity. However, again, it does not include transactions with owners such as buying back of shares or payment of dividends. Useful financial reporting is constrained by the cost of providing and using information. Ideally, the benefits derived from the information provided by financial reporting should exceed the cost of providing and using such information. The two most important underlying assumptions of financial statements are the accrual basis and the going concern. Accrual basis requires that financial statements reflect transactions in the period in which they take place rather than where cash changes hands. So, an expense incurred but not paid should be recorded in the period in which it has incurred. Similarly, sales made but cash not collected from the customer should be recorded in the period in which the sales are made, irrespective when the cash is collected. The assumption of going concern implies that the company is expected to continue to operate over the foreseeable future. This assumption has significant implications for reporting the financial position of the business. For example, consider the value of a company's inventory if it can be sold over a normal period against the value of the same inventory if it is assumed that the inventory must all be sold immediately in a day or a week time. As per the IFRS, financial statements include statement of financial position or balance sheet, statement of comprehensive income or profit and loss account, statement of changes in owner's equity, statement of cash flows, and notes to the financial statements. Reporting entities are also encouraged to furnish other related financial and non-financial information in addition to that required. Financial statements need to present fairly the financial position and financial performance as well as the cash flows of an entity. General features of financial statements include fair presentation, which is achieved through the application of IFRS. Financial statements are expected to fairly present the economic reality, that is the transactions and circumstances of the reporting entity. Financial statements are prepared on a going concern basis unless there is an intention by the management to liquidate the reporting entity or cease trading of business or has no realistic alternative but to do so. If due to any reason the financial statements are not presented on the basis of going concern, the fact that this is not on the basis of going concern and the rationale underlying must be disclosed. Financial statements are prepared using accrual basis of accounting. Omissions or misstatements of items are material if they could individually or collectively influence the economic decisions that users make on the basis of financial statements. Each material class of similar items is presented separately. Dissimilar items are presented separately unless they are immaterial. No offsetting of assets, liabilities, income and expenses is allowed unless it is required or permitted by the International Financial Reporting Standards. Any reporting entity is required to prepare financial statements at least annually. Reporting entities should include in their financial statements comparative information from the previous periods. The comparative information of prior periods is disclosed for all amounts reported in the financial statements unless the International Financial Reporting Standards requires or permits otherwise. Financial statements are prepared and presented consistently over time. The presentation and classification of different items in the financial statements is usually retained from one accounting period to the other. The structure and content of financial statements is specified in the International Accounting Standard number 1, that is IAS number 1. This standard requires that the reporting entity reports the balance sheet to distinguish between current and non-current assets and between current and non-current liabilities. However, if a presentation based on liquidity provides more relevant and reliable information, such as in the case of a bank or any other financial institution, it is allowed. International Accounting Standard 1 also specifies the minimum line items to be disclosed on the face of or in the notes to the financial statements. For example, reporting entities are required to disclose the amount of their plant, property and equipment as a line item on the face of balance sheet. Same requirement is for inventories, trade and other receivables, cash and cash equivalents. Similarly, this standard also specifies the information required to be presented as part of the financial statement in the notes to the financial statements. It requires that the information in the notes to financial statement must be presented in a systematic manner and should be cross-referenced from the face of the financial statements, that is, income statement, balance sheet and cash flows should contain references to the notes. As discussed earlier, the standard requires that comparative information for the previous period must be provided in the financial statement. It is essential for any financial reporting framework to be coherent. A coherent financial reporting framework has three characteristics. It is transparent, it is comprehensive, and it is consistent. Transparency is achieved through full disclosure and fair presentation. Transparency means that users of financial statements are able to understand the underlying economic reality of the business from the financial statements. A financial reporting framework is considered comprehensive if it encompasses the full spectrum of transactions that have financial consequences. These transactions can be existing or newly developing one. Such a framework is based on universal principles that are able to provide guidance for recording both existing and newly developed transactions. Consistency implies that similar transactions should be measured and presented in a similar manner regardless of industry, company size, geography, or other characteristics. A coherent financial reporting framework is expected to provide consistency across companies as well as time periods. At the same time, such a coherent framework has sufficient flexibility that permits companies discretion in reporting results in accordance with their underlying economic reality. However, there are certain barriers that create inherent limitations in any financial reporting standards framework. These include valuation, standard setting approach, and measurement. There are different bases for valuation. These include historical cost, current cost, fair value, realizable value, and present value approaches. The element of judgment across these valuation approaches vary. For example, historical cost requires little if any judgment. However, the other approaches to valuation require a lot of judgment. In addition, financial reporting standards can be established either on principles or rules, or a combination of both principles and rules, sometimes referred to as objectives oriented. Principle-based approaches result in financial reporting framework that are broader and that have limited or little specific guidance on how to report particular elements or transactions in the financial statements. Therefore, standards based on principle-based approaches involve a lot of judgment. On the other hand, rule-based approach establishes specific rules for each transaction or element of financial statement. It provides specific guidance for each element or transaction and hence leaves limited scope for judgment. Therefore, differences in standard setting approaches also present a challenge towards coherent financial reporting framework. Another barrier is the difference between measurement. The balance sheet presents elements at a point in time. and the income statement reflects changes during a period of time. So balance sheet is presented as on a given day, while the income statement is presented for a given period of time. Because these statements are related, standards regarding one of these statements will have an effect on the other. Financial reporting standards can be established taking an asset liability approach, which gives preference to proper valuation of the balance sheet items or elements, or a revenue and expense approach that focuses on the income statement. This conflict can result in one statement being reported in a theoretically sound manner, but the other statement reflecting less relevant information. However, in recent years, standard setting bodies have predominantly preferred the asset liability approach over the revenue and expense approach. Companies are required to provide disclosures of significant accounting policies in their financial statements. Accounting policies and estimates are disclosed in the notes to financial statements. A discussion of the significant accounting policies is also provided in the management commentary, also known as the management's discussion and analysis. Any changes in accounting policies or estimate is also disclosed in the notes to financial statements, and significant changes are also discussed in management commentary. Here we have an example of the MD&A disclosures of significant accounting policies from the Colgate-Palmolive Company's 2011 annual report. The discussion describes that the US GAAPs allow the selection of alternative accounting methods and that the company is using alternative methods to account for shipping and handling costs and inventories. Details on the use of these alternative accounting methods to account for shipping and handling costs and inventories have been provided here in the discussion. The notes then disclose that the shipping and handling costs have been classified as selling, journal and administrative expenses and reported in the income statement.